Hello, my name is Jaylene Howard. I'm a consulting director in Russell's U.S. Private Client Services Division, and I'm joined today here in Seattle by my colleague, Gerard Fitzpatrick, Chief Investment Officer of Fixed Income. Today, Gerard joined us specifically to talk about Russell's outlook for the fixed income markets. Gerard, thank you for joining us.
It's a pleasure. Thanks, Jaylene.
Well, let's get started. One unexpected feature of the fixed income market in 2014 was the decline in U.S. Treasury bond yields. They started near 3% at the beginning of 2014 and ended around 2.2%. As we look out into the year ahead, Gerard, can you share our current outlook for interest rates in the U.S. and abroad?
Absolutely. So many people thought Treasury yields could only go one way, it was up, and they went down last year. So where to from here? Our view from the fixed income team and how we're positioning portfolios will be an expectation that Treasury yields will rise, but modestly rise at about 2.5%. Why? We think that ultimately the strength of the US economy will continue. We see that leading towards better unemployment numbers, and we see that really leading into some wage inflation pressures. So we think that that will likely cause the Fed to start to increase the Fed target rate probably in the second half of this year. So that's where our portfolios are positioned, expecting that Treasury yields will rise. Against that, there clearly are some factors that are bullish for Treasuries. You look at the global slowdown, what's going on, you look at the disinflation or the deflationary pressures, particularly from oil prices, and you look at the central bank activity from Japan, but also particularly most recently from the ECB in Europe. All of those factors should be relatively positive for Treasuries. So on net, we think they're rising, 2.5% at the end of the year, and we're positioning our portfolios to be slightly biased underweight duration risk.
Well, and you mentioned both the ECB and Japan implementing quantitative easing. So we have, for the first time in a while, diverging central bank policies. How may that impact our fixed income portfolios?
It's definitely a dynamic. There's decoupling going on with central bank activity, unprecedented QE from the ECB, 1.1 trillion that they've expressed from QE. What that's going to do, it's going to bring down those yields of the government bond market in Europe, particularly German bond yields. So if some people look at the US and say, US yields, they seem to be relatively low. Look at Germany. Look how low those are. The dynamic in play in the bond markets is called relative value. If German yields are relatively lower than the US, those US yields, all of a sudden, they become a bit more attractive. So that's a dynamic that effectively brings down the US yields as German yields are relatively low.
With bond yields currently so low, and with the expectation that credit spreads won't narrow much further, how are you and your team positioning our Russell funds to generate returns in this low interest rate environment and also manage risks?
That's right. Those credit spreads, they've done fantastic in recent years following the global financial crisis, really supported by the Fed. But we think that the best times for credit are over. We think credit spreads will stay relatively neutral, but potential for some spread widening now. So we're somewhat cautious on credit. We still believe the spread on offer, net of any spread widening, will be positive versus Treasuries. So we think credit will beat Treasuries. However, there's that uncertainty. There's the potential for what we call left tail risk, or credit spreads blow out to be relatively high levels. So with that, we're cautious in the amount of overweight we have towards credit. Currently, we're at the lowest overweight to credit that really we've ever had. And we're certainly more defensive compared to peers. So we're not seeking the highest yielding out there. We think that's too greedy in a market where you need to be somewhat fearful, and we're cautious. So we're cautious on credit. How are we going to win though? We've got other diversified sources of return, the likes of global government markets, global currencies, and diversification across several credit sectors. We've been doing this for the last couple of years, building in and getting ready for the time that we see coming very soon, where you need to be more diversified and you need to have high quality protection in your fixed income portfolio to serve you on a multi-asset level.
Well, and what I really picked up on there was, one, you said we're being very selective, and I think that that's important, an important way for us to manage risk. And then two, you talked about diversification, specifically currency. I also wanted to talk about another factor that's been impacting the global bond markets, and that's commodity prices. Do you expect higher defaults?
We do. I think it's natural. The default risk is likely to go up, particularly in a prolonged period of low oil prices. We'd estimate if oil was less than 50 for 6 months, we could see that default risk starting to go up. However, to a large degree, that's already priced in. And if you've got carefully selected bonds to the energy sector at good prices from here, we feel that that's a good investment going forward.
So thank you for sharing your insights and your perspective with us today. We certainly appreciate it.
You're welcome.
And for those of you who'd like more information on Russell's suite of fixed income funds, please don't hesitate to call or visit our website.